time and hope it's a good night. My name is Alexandra Schweiger. I am the Young Alumni and Student Engagement Specialist at the CSU Alumni Association, and I am joined tonight by Nancy Patton and Kevin Holt, both Canvas experts. They are here to answer your questions, address any curiosities. Please feel free to paste anything in the chat. A couple of just housekeeping things. We will keep your video and sound off the entire time, so don't worry about surprise attacks or anything if you have dinner or kids or whatnot. We do encourage you to introduce yourself in the chat, so if you could put your name, your grad year if you're a CSU alum, and where you're logging in from. We have folks all over the US. Both Nancy and I are in Fort Collins, and I believe Kevin's in Fort Collins too.
I think it's Loveland.
Loveland. He's in Loveland. I was going to say, correct me if I'm wrong. So again, when you type, you can type either to all panelists, just Nancy and I will see your question, or all panelists and attendees, which is how we encourage you to introduce yourself. We will keep all polls and questions anonymous, so I'll read the questions just so folks know what's being asked, but I won't say your name, and just in case that's a concern. And then I just want to give a huge thank you both to Canvas Credit Union and to our CSU Alumni Association members. Without that awesome duo, we wouldn't have programming like this. So your membership and Canvas Credit Union really does make programming like this possible. If you're interested in supporting through Alumni Association membership, I'm more than happy to chat with you about that. Send me a chat, or alumni.colostate.edu is a great resource too. But with that, you didn't come here to hear me talk. I'm going to turn it over to Nancy to talk about home buying.
Well, awesome. Thank you so much. We love this partnership. Welcome to our home buying seminar. I'm Nancy Patton with Canvas Credit Union. I'm going to lead the discussion tonight, but I'm thrilled that Kevin Holt from our mortgage team is also in the house. And so he's going to be able to answer some of your very specific questions. And with Alexandra managing chat, we have an amazing team to help you learn all about home buying tonight. There are several times where we are going to do some voting through the polling system. And so those are anonymous. We hope you'll answer those. And then, as Alexandra mentioned, if you missed it, the Alumni Association sends out a post-class evaluation, and then the slides from tonight will be included with that. So, who's ready for a poll? Can I launch them, or do you need to do that? Awesome. So just a couple questions, and we'll have you answer those.
And just as a reminder, it is anonymous, so if that's a concern, just wanted to reassure that it's anonymous. We have about 36 of you have answered so far, so we'll give it another 30 seconds. What do you think, Nancy? 10 more seconds?
Yeah, let's share it out.
Okay. If you didn't answer, now's your final chance. And
here's who's here tonight. We have a few people that don't have to pay. We have mostly renters. We have a couple already homeowners, including somebody who owns their home free and clear. Congratulations. You're rare in this class, and actually rare in most of America, so good job. We have mostly Northern Colorado here, but a nice smattering of other places. There were some amazing states represented in the discussion, or I'm sorry, in the registrations. So that was cool to see. And I just want to stress that for those of you from out of state, you'll need to adapt some of the numbers we're going to talk about for your location, but the concepts we're going to cover are the same regardless of where you live. So thanks for doing the poll. Let's talk a little bit. You know, you can't do a class without talking about what you're going to talk about. So this is how we're going to go through the session. Some initial thoughts that you should have before you jump into homeownership. We're going to go into all those nasty things like definitions, but it'll help you be in a stronger place as you move into the buying process to understand the terminology. We will touch on refinancing only if somebody tonight wants to talk about that. So would you please, if you are interested in a short discussion about refinancing, would you put that in chat so that we include that when we get to that section of the presentation? And then we'll talk about the market today using a realtor, and we'll end with some resources that you can have to do some more research on your own. That's what we're going to do. Let's do it. What we're going to talk about first is some things that you should be thinking about and acting on several months, probably at least 6 to 12 months before you're planning to purchase a home. So the first thing is actually to decide if you are right for being a homeowner. And there are absolutely advantages to owning a home. Okay, so by the same token, there are responsibilities, and ownership is not right for everyone. So one advantage of being a renter is you're able to make a move easier. Maybe you get a career opportunity and you can, boom, just pick up and go. When you own a home, you're responsible for repairs and maintenance, or else you have to pay somebody for those things. So I have several colleagues who rent, and while I'm spending my weekend pruning shrubs and mowing the lawn, they're off on some amazing weekend trip. Countering that, I have a great yard that my dog and my grandchildren play in. So different things to consider. If my water heater goes out, I have to pay for it, and I have to pay for it right now. I can't call my landlord and say, help, there's a problem. But I also get to pick my paint colors. And if I want a purple door, because that's my style, I get to pick a purple door. Unless my homeowners association says that that's not in the color palette. So multiple things to consider. Are you the kind of person who is ready to be a homeowner? For many Americans, it's a source of wealth. And for many Americans, it's a source of stress. So do a little research, a little dig deep into you, and see if you're ready for this adventure. And besides emotional considerations, we also want to think about some financial considerations before we jump too far down the road. I bet you've heard you should put 20% down on the purchase price. Okay, we're going to talk in a minute about why people do that, but that's a big number. So on a $350,000 home, that's $70,000. And the good news is it's not a necessity. Okay, so there are many down payment options, and saving for a down payment is a fabulous idea. Coming to the table, coming to the purchase with down payment money is a great idea, but don't worry if you can't come up with 20% down. Another great idea is to be sure you know what your credit report and your credit score are. So you want to do this at least 6 months out so that if you find issues, you'll have time to work on those. Those don't get fixed in a couple days. You may even be able to raise your score and thereby qualified to save some money either on the interest rate or on some of your other expenses. Right now, because of the pandemic, there actually is an opportunity for you to get your reports. Now, this is not your score, but you can get your credit reports every week until April of 2021. And I'm not sure I'd want to get mine every week, but this is more frequently than we traditionally are given free access to our reports. So if you haven't looked at your report, go to annualcreditreport.com, get your reports, make sure they're accurate, start working on some things that should be fixed up. But that's something going on right now that isn't always true, that you get free reports clear into April of next year. Another number that you want to start thinking about and working on is your debt ratio. We'll bring this up again, but I want to define it. It's your monthly debt payments. So that's your mortgage, a vehicle, a credit card, a student loan, anything that's court mandated, any loan payment. The monthly payments on your debts divided by your gross monthly income. And if that ratio is above 40%, then it's going to be more challenging for you to get a mortgage. So one of the first things you may want to work on is paying down some of your debt May need to take a year to do that and get your ratio lower. So that's a great starting point, is know that number. Another thing to know is your budget. So how much can you really afford to spend every month on housing? Please be brutally honest with yourself. I don't know if you've heard about being house rich and cash poor, but that means that you are paying so much for your home, paying so much on your monthly payment that you have no money left for fun or for your life or for emergencies. So please be honest in looking at your numbers and say, how much can I really afford for a monthly payment on a home? All right, so having sounded all negative for a little while there, let's jump into something that might give you some hope.
Can I jump in with a quick question, Nancy, related to the last
Absolutely.
slide?
Yeah.
Does getting your credit report lower your credit score? I've heard rumors like that before.
No, no, no. So great question. Thank you for asking that question. Whenever you check your own reports, even if you get your own score, and we'll talk more on that later, but those never impact your situation. That doesn't affect your score at all if you are looking at your own information. Okay, so great, love it. So here's some numbers about comparing. I've talked about numbers before, but you're going to want to look at actually how this comes together when you're looking at a mortgage payment. This is a comparison of being a renter in Denver and finding a condo or townhouse in Denver, putting some money down, and what the monthly payment looks like. So let's talk about being a renter. You have rent. This was the average rent for a 2-bedroom apartment in August. And then you have some, usually you have a small renter's insurance payment, and that's your, how much goes out the door each month. Now, utilities may or may not be included, HOA, that kind of thing, but here's a baseline approach to comparisons. When we start talking about a mortgage payment, you got to add in a couple different things. One is your principal and interest, that's paying back your loan. You're going to have taxes, and we'll explain more about why it's $150 instead of $2,500. But so here's some taxes that have to be included in your payment. You'll need to pay for homeowners insurance. You'll need to pay mortgage insurance, maybe. Depends, we'll talk about that too. But in this example, by putting down 5%, your monthly payment is lower than being a renter. You have to run these numbers yourself. You have to know what to add in. We'll talk about some of these numbers coming up, but it's important to go ahead and take an honest look. You may be surprised. You may be surprised that you can, in fact, afford getting into your own place. So we will dive into some definitions on some of these terms and how this all fits together, but I wanted to give you a little hope after sounding kind of negative there for a while.
And can I pop in with another question?
Absolutely. The next thing we'll do is a poll. So let's do the question.
So the question is, does debt to income ratio include credit card debt that is paid off monthly? For instance, if you pay for everything on a credit card and pay it off every month.
It still shows up. So yes, what they're going to look at as a lender is the fact that it looks like your monthly payment is something because most people don't pay in full. So they're going to assume that you owe that monthly payment amount when they're doing the calculation.
And then as a follow-up question, and thank you to all of you who are putting questions in the chat. We'll keep answering them as we can. But it's, can we discuss refinancing in terms of rolling a first-time buyer loan into a better interest rate soon after purchasing? Do you need me to repeat that one?
Kevin, I'll let you ponder on that, and launch the poll so that people can be working on that. Say the question again, and Kevin, see if you can interpret an answer for that one.
So the poll is going. Kevin, just to repeat the question, and I'm trying to ask, I know some of you have popped in questions that'll fall later in the presentation, but this one, I admittedly wasn't sure where it would fall either. So it's, can we discuss refinancing in terms of rolling a first-time buyer loan into a better interest rate soon after purchasing?
Yeah, you have to wait at least 6 months to do the refinance after purchasing the home. But yes, it's certainly possible to, as interest rates have dropped, and if you're, in a first-time home buyer loan that doesn't have the most ideal rate, but your credit scores have improved since, and yeah, by all means, you can always, after 6 months, you can look at refinancing for a lower rate.
And that's why we have Kevin on the call tonight.
And again,
All
if you have follow-up questions, feel free to keep popping them in the chat and we'll get to them.
And guys, I just want to touch back on that one credit card question, if you don't mind. The one that if it's paid off every month, it really depends on when the timing of the credit card is reported to your credit bureau. If the credit card is reporting a zero balance, then we're just going to show a zero balance. We're not going to include that into your debt to income ratio. But if the credit card does show a balance, like it reported it, but you paid it off a few days later, but it actually shows on your credit report, then yeah, we're going to include it.
So a great clarification, Kevin. I was assuming that it was somebody who used the card, paid it off in full, and used it again. Therefore, there would always be a balance showing on the report. But
yeah, if they pay it off and the credit card company reports it with a zero balance, then yeah, we won't include that in your debt to income ratio.
Depends on your paying cycle, your use
right,
cycle.
Yeah, it just kind of depends on the timing.
All right, well, most people have voted. Let's take a look at, this was about acronyms. Hey, okay, so most of this crowd does not understand these acronyms. Most people don't. Most people who've even bought houses don't understand these acronyms. So are you in luck? You're in the right place. We will talk through all those fascinating letters. And yes, you guys are well informed. Interest rates are amazingly low, still hovering in the 3% range. Kevin, do you have a number for today? What today's mortgage rate was?
Our 30-year term starts as low as 2.875%.
Okay, so I cannot stress enough, these are historic lows. Wow. I mean, look at that. Back in 1980, when I bought my first house, it was 13% interest. So that 3-ish% is looking amazing. So thanks for taking that poll. And we are about to jump into a bunch of definitions, a bunch of terms, defining those acronyms. So I just, again, want to stress, if something doesn't make sense, if you still have questions, please chat, because there is a lot of words coming up, okay?
And just to reiterate, for those of you pop in questions in the chat, there's quite a few coming through. We will get to all of them, just making sure we're doing it at strategic times. So just wanted you to know that we're seeing them.
Awesome. So there's a lot of different kinds of loans out there. When you get a loan for a home, that's called a mortgage, and mortgage lenders realized people were in different circumstances, different challenges. They have come up with all kinds of different products and loan styles, loan types, to make sure that as many people as possible can get into home ownership. So we're going to talk through some of these differences. The first three that are listed there, FHA, VA, and USDA, are all government-backed loans. They are designed to help specific people or help buy houses in specific locations. So the FHA program is designed for people who are first-time buyers, someone who might have a lower down payment or a lower credit score. So this loan type is geared for those purchasers. Most FHA loans are going to require mortgage insurance is to be part of the payment for as long as you have the loan. That's just the way an FHA loan works, okay? VA loans are fabulous, but they're only available for veterans. They have lower closing costs, no down payment requirement, low interest rates, extra safety standards that go with the process. If you are a veteran, please look into getting a VA loan. It's an amazing product, only for veterans. In the same way, USDA loans are only for homes in specific locations. The concept here is that they're targeting rural areas that may be slower to develop than some urban settings. And so there are special loans available in that geographic setting that might not be available in Metro Denver or the suburbs, okay? So those 3 loans are targeted for very specific circumstances or people, and those are backed by the government, okay? When we talk about a conventional mortgage, this is offered by a private lender. It probably will have a higher credit score expectation, but it can be a little more flexible. So for instance, we bought a home with our daughter, and that wouldn't have fit into the FHA lending arena, but because we weren't going to live there. My daughter is going to live there, but we're on the loan with her. So we needed a conventional mortgage. It was more flexible to handle that situation. Conventional loans often are at a lower interest rate if you have a good credit score. And conventional loans are where the 20% down idea comes into play. If you put 20% down, and that's a rough number, sometimes it's like 20, anyway, I don't want to get in the weeds, but if you put 20% down, you will not have to have mortgage insurance added to the loan payment. Okay, only on conventional. That's not true. You could put 50% down on an FHA loan and you still have to have the mortgage insurance. But with a conventional loan, if you hit 20% of a down payment, then you can avoid having that mortgage insurance added to the payment. There's a jumbo loan. Jumbo loans are for higher loan amounts. And the definition of that amount, the level that is designed to be jumbo, is determined by where you live. So in most of Colorado, the amount is $510,400. If you were to get a loan for $510,500, you would have to get a jumbo loan. It's above that minimum. In the Denver area, it's higher than that 510, it's 575. In Boulder, it's 644,000. So depending on where you live, the line that says above this amount is a jumbo loan is determined by where you live. Some of those jumbo loans, because you're borrowing more money, may require a higher down payment, more proof that you have savings. There may be some other qualifications you have to go through because you're borrowing so much money. And those last couple loan examples there, a combination loan and the Canvas 100% home loan, are designed to help, again, very specific situations. So the combination loan, I'm going to use an example of $100,000 because I can do the math really easy. If you were going to get a loan for $100,000, what you would do in a combination loan is put down, or you would have a first mortgage of $80,000, 80% of the loan. You'd have $10,000 in a second mortgage, and you'd put down, bring to the table cash, 10% or $10,000. So what do you think we're achieving by having $10,000 down and a $10,000 second mortgage? We've hit our 20% down and can avoid mortgage insurance. Okay, so mortgage lenders are very clever people. They have come up with amazing programs to help people get into the home ownership process. That's just one example. Canvas came up with one where we'll loan 100% of the purchase price. It's got a few qualifiers, so need to do some research on that one as well. But my point is, look at all these different kinds of loans. There's something that's geared for whatever your situation is as you get into home ownership.
So a question on the conventional loan.
Yeah.
Can you do a conventional loan with a down payment less than 20% and still not have to pay PMI if you have great credit and minimal debt?
I'm shaking my head no. Kevin, do you need to contradict me?
No, every lender is going to charge mortgage insurance with less than 20% down, regardless.
Yep, you can be an amazing person, doesn't matter. Well, it matters to us, but it doesn't matter to the lender.
It does matter to us. Thank you both.
All right, that was it?
That was it on that. I do have a couple questions if we want to go back to debt to income ratio.
We're going to dive into it pretty soon.
Perfect.
Okay. So those were the different kinds of loans. Let's jump over to some more terminology. And actually, the first thing we're going to talk about is the term of the loan, the length of the loan. And the most common is a 30-year mortgage. There's a very good reason for that, because the purchase prices are so high that most people can't afford the monthly payment if it's one of those shorter loan terms, like a 10-year or 15-year. So an example, if you have a $300,000 loan and it's a 30-year term, the payment's about $1,500 a month. But that payment goes to $2,300 a month, so $800 more a month by going to a 15-year loan. So again, most people need the price break that comes with stretching out the loan term. So I think that makes sense to most people. Let's jump into terminology. Here's where all these acronyms come in. Loan to value is comparing how much you borrow divided by how much the home is worth. So lower is better on this one. If your loan is $200,000 on a $300,000 home, your loan to value is 66%. If your loan is $299,000 on a $300,000 house, now your loan to value is 99%. As a lender, we're much more comfortable giving you money that isn't maxed out compared to the value of the home. Okay, so that's loan to value, just a simple comparison. Debt to income is another ratio that we want to see low, and we already suggested that you be below 40%. It's the total of your monthly debt payments divided by your gross monthly income. So again, a lender is more comfortable knowing that your mortgage payment isn't going to be so high that you can't afford your other loan payments. You already have existing obligations to lenders, and so they aren't going to put you in a loan that's going to stretch you and make you not able to pay your previous loans. Okay, that was debt to income. Do we want to take the question?
Sure. I have several different monthly payment options for student loans. How do lenders account for this as part of the debt to income ratio? Can I lower this ratio by selecting a payment option that has a low monthly payment?
Yeah, so it's going to be what's showing up on your credit report. So whatever program you have selected and is showing on your report, and that's where pulling your report and seeing what it says on the credit report, this is my monthly payment, that's where they're going to get that number.
And shameless plug on that, but we do have a student loans webinar on alumni.colostate.edu, also led by the fabulous Nancy. So if you want more information there. As a follow-up question, can you pay off a loan before the end of the term?
A mortgage loan? Absolutely. Now, the other thing you can do is pay ahead every month. So these days, nobody really does any kind of payment penalties for paying ahead or paying off early. but it can't hurt to ask your lender, but that's just really not a common thing to have any kind of penalty. You can always, assuming, pay more. So if your monthly payment is $1,200, you can pay $1,300. Absolutely, brilliant move. If you win the lottery and can pay off a $400,000 home loan, you go for it. That's just fine. Shouldn't be any penalties.
And then one last question. What makes you a high qualifier?
Kevin, do you want to dive into that? There's several factors.
Can't hear you, Kevin, but let me know if you
Yeah.
need me to repeat the question.
So I'm going to start with things that get you qualified easily are going to be a high credit score. Things that make things go smoother is that you've been on the same job or a very similar job for a long time. Perhaps you have a very stable rent situation or living time, you've lived in the same place for a long time. So anything that shows stability will make you easier to qualify. All those ratios play into the decision. And so just, it really comes down to a bunch of numbers, the ratios, stability in employment, stability in where you've lived. Those are all positives. Credit score. All right, it looks like Kevin popped off, probably hoping to try back on again. So we can come back to that if we think we've missed anything, but lenders like to see stability.
Kevin did say he was having some tech difficulties, so if he pops back on, we'll let him build upon that. One last question. They keep coming in, and these are such good questions, so thank you all. Is it a good thing to get pre-qualified for a mortgage?
You will need to be pre-approved. So we'll talk about that coming up. Hang on, it's coming in a couple of slides. Let's jump into the definition of PITI. We hinted at this when we looked at the comparison between renting and owning, getting a mortgage. PITI is principal, interest, taxes, insurance. So you probably expected if you get a mortgage, it's common knowledge that you pay back a loan, you pay back the principal, and you pay back the interest amount. So that's part of your monthly payment. What most people don't know when the first time they buy a home is that your lender is also going to collect 1/12 of your property tax and 1/12 of your homeowner's insurance. And then they pay those bills when they come due. So what we've got is principal, interest, taxes, and insurance. You're going to pay back your loan, principal and interest. The lender is going to collect taxes. Each month they'll collect 1/12 of what will be due, and when it comes due, they pay it. And each month they collect 1/12 of your homeowner's insurance, and then they pay that bill when it comes due. They keep that money, that tax and insurance money that they've collected each month, in an escrow account. And by law, they can't keep too much. So they can't over collect and hold money. They can only collect enough to make the payment. By the same token, they're going to have to evaluate. Often those expenses go up. And so once a year, they may send you a letter and say, hey, we need to collect a little more than we did last year because your taxes have gone up. And so in order to make the payment on time, we're going to need to increase your monthly payment to have that money available when it comes due. There are alternatives to that. You can pay lump sum. You can do other things in the moment to keep your original payment the same. But the point being, every year, the amount of money in escrow is evaluated by the lender. They can't keep too much and they can't be short. So they'll reevaluate the situation and communicate with you. Sometimes people ask, well, why do they do that? And it's because both of those amounts of money, your property taxes and your homeowner's insurance, can be big enough that many people aren't prepared to pay it lump sum once a year. So they have found that putting it into the mortgage payment a little bit at a time is a much better system to keep everything paid on time. So that's escrow and PITI. The last two acronyms up there are really the same thing. It's the mortgage insurance thing. One is mortgage insurance premium, and one is private mortgage insurance. One goes with FHA kind of loans, government loans, and one goes on conventional mortgages, but it's exactly the same concept. So when you pay homeowners insurance, like we just talked about in the PITI, that's to protect you if there's hail or a fire. Mortgage insurance protects the lender in case you don't make your payment. So if you default on the loan, there is insurance in place to protect the lender who has loaned out that money. And that's the mortgage insurance part.
And then
okay, that was a lot of terms. Kevin, nice to have you back with us.
I'm going to throw one more question at you. What is the difference between title company escrow and mortgage escrow?
Kevin, do you want to handle the details on that?
Yeah, a title company's escrow is more like they're collecting, I guess, everybody's that's involved in the transaction, collecting their funds, and then disperse them out to the different parties, such as the realtors, inspectors, appraisers. That's their escrow. Your mortgage escrow is just for your taxes and your insurance. And that you being your homeowner's insurance.
Yeah, so that's a great, I think it's, so the title company escrow is related to the single event of signing and distributing things related to the purchase. Whereas the escrow we're talking about with PITI goes on for the life of the loan.
Correct, yeah, that's a great way to explain it.
And then a follow-up with that is, are there fees associated with the lender handling the PITI escrow account?
No.
We don't charge any, and I don't believe, I haven't seen any other lenders that do charge it. They may charge you for waiving escrow. So if the lender is not collecting it for you, they may charge you a fee for that.
Thank you. I think that's all we have for now. Good questions, friends.
All those acronyms, and that's okay. I feel pretty good. Let's take a look at, did we have anybody that wanted to talk about refinancing?
Yes, we had just right off the bat. Could you talk a little bit about what refinancing is and why you would do it? And
Sure.
then I'll have a follow-up question too.
Okay, so refinancing, the concept is you got into a home loan, you're making your mortgage payments, something's changed, and you want to have a different loan instead of the one you have. And there's a couple reasons for that. One might be that interest rates have dropped. Maybe your credit score went up. Maybe you inherited money and you could pay down a big old chunk of that mortgage and start over for something. Maybe you want to, maybe you got divorced. And so the home that made sense for two of you or doesn't make sense anymore. There's maybe you've hit that 20% of equity and you can stop paying mortgage insurance. There's a bunch of reasons that people choose to refinance. The biggest question, the biggest thing about does it make sense for me is that there are fees associated with refinancing. And so are you going to be able to stay in the home long enough to save money on your new payment to recover the costs of the refinance? Another couple questions that you want to be sure you ask before you jump into a refinance is, in fact, will you qualify? Has your credit score stayed strong or gone up? If your credit score has gone down, you may find yourself that a refinance doesn't make sense. You have to consider a second mortgage. How are we going to pay that off, include that, whatever. So the big thing though is, are you going to save enough money every month and stay in the home long enough to recoup the costs of the refinance? Okay.
I think you'll cover the next one, but it says, please speak about refinancing and private mortgage insurance.
So that would be one of the reasons you would refinance, is that your equity, you've been paying in long enough, that your equity in the home has built up, and now you own 25% of the home. And so there's no longer a need. Now you'd have to be in a conventional mortgage. If you were in an FHA mortgage, that's not going to matter. Okay. Unless there's other things, we can circle back to that later, but I'm going to leave it at that. The vast majority of people on the session tonight were more interested in purchasing than in refinancing. So we do want to talk about why you might want to work with a realtor. Boy, the process of buying a home can be complicated. It doesn't get any easier as time has gone by. It is really intense right now, at least in Colorado. And you just saw all those different options related to lending, all the different products you could get into. Plus, there's the whole search for a property. We strongly counsel that you work with a realtor because of their knowledge of the market, because of their knowledge of the process that you have to go through. They can help coach you through the documents that you're signing. Along the way, there'll be negotiation on a couple of times. And to have an advocate in your corner helping you understand what is worth fighting for and what you can just let slide, it's okay. That's a really strong benefit for you. There are a couple different contracts you can sign with a realtor. You want to be sure that the realtor is representing you and your interests. So be sure you understand the relationship you're going to have legally with the realtor. And there are so many realtors. So I have some specific questions that you can ask a realtor, but there's different styles. This is a kind of intense process. Try to find somebody you're really comfortable working with. You can ask your friends. You can ask somebody that just bought a home. How'd it go? Did you like your realtor? Interview them. But some questions to ask is, how many homes do they sell every year? So if they're not selling, 12 homes a year, about one a month kind of thing, maybe they're not in it full time. Maybe they're just getting started. Maybe they're not very good. I don't know. That would be a one question to ask. How long have they been in business? Is it their full-time job? Do they have references they can give you? So those are some very specific things you can ask a realtor. And it's really nice that your cousin just started selling real estate and that you want to support them. But this is a big dollar purchase. And it's really stressful as far as what's going on in the market right now. Please be very wise in your choice of realtor. Any realtor questions?
I think we're good.
Okay. We suggest you have one. All right, we're going to launch another poll. So these questions are related to Colorado. My apologies to the rest of the country who's in attendance, but for at least the first question's about the Denver market.
We're about halfway there, so we'll give it another 15, 20 seconds. We'll say 10 more seconds. Get it in if you want to answer, if you want to guess. Again, it's anonymous, so.
Oh, and we're evenly split on that last one. So take a guess, it won't hurt you.
All right, we're gonna share it out.
Okay, So I have to tell you that, so obviously in 2010, that's only 10 years ago. 10 years ago, the average home price was $259 in the Denver market. It is now $600,000. I learned that number today, and I about had a heart attack because the 471 is the range that I was seeing just a few months ago. Now, 471 is median. So thinking back to your economics class, median means half of the prices are above and half the prices are below. Average is just the whole thing divided by how many sold. So average prices sometimes are higher than median prices, but it's still pretty alarming, and I about had a heart attack when I saw that it was $600,000 for an average price. So if you want to go with median, it's a much more affordable 471. We'll talk about some other numbers related to that concept as well. So 2 months of home inventory basically means that everything that's on the market today would sell in 2 months. And so that's a seller's market because about 6 months is considered medium. Okay, so when everything that's on the market at the moment is expected to sell in 2 months, that's the advantage to the seller's market. Okay, we will move on and talk about a couple other things here. And so what is happening, you know, thanks for giving your opinions. Like I said, if I hadn't done the research today, I would never have guessed 600,000. We would have expected with the pandemic that home prices would drop or that people wouldn't be buying. But in Colorado, home prices have not only been stable, they've gone up. And that was from a starting point that already seemed pretty high. So we'll talk some more numbers in a minute. There, you know, of course, there wasn't much sales action back in March and April, but that pent-up demand has hit since then and sales have been strong. We're going to talk inventory in a minute because that's an ongoing issue, particularly in the lower price points. So that's kind of an overview. Let's look at some specific numbers.
And can I jump in with a question related to that overview?
Yeah.
Where can you monitor if it's a buyer's or a seller's market?
So you can Google things like Denver median price, and often the sources for that list all of that. Usually there's a realty group in an area that does some tracking of those kind of things. Kevin, do you have a specific, like this information is always found here?
Well, yeah, like you were mentioning, Nancy, it's, you know, realtor associations that are in the area. You know, Fort Collins definitely has a great realtor association that you can check their website, and, you know, they have a lot of great information there. Or just having your individual realtor, you know, and that's really where a realtor comes in to help out and, you know, be able to discuss, you know, what area really is a buyer's or a seller's market, because it changes from neighborhood to neighborhood.
That's a great point, Kevin. I often get data to update these presentations because I'm on an email list for a couple of different realtors, and they share out what's going on. So great point.
Mm-hmm.
And then as a quick follow-up, are realtor fees paid by the seller or buyer in Colorado?
Seller. Yes. So you have to figure that the seller has kind of incorporated that into the purchase price. But the fact is that if you are a buyer, technically, you don't pay the realtor. Good question. Good question. Okay, so here's some data. This time on this slide, I went with median price instead of average. So remember, median, some are above, some are below, half are above, half are below. Look at these price differences. Greeley and Boulder are 50 miles apart. 50 miles apart. Median price Greeley, 330. Median price Boulder, 1.1 million. Okay. There's a saying, you drive till you qualify. So if you live in Longmont and you can't qualify in Boulder, drive east until you qualify. So Obviously, each market is very unique, and this is a vivid example. So not just about the price point, but often the inventory then. I mean, just think about that. If you're looking for a home that's less than $400,000, well, where is a much bigger inventory of that price point going to be? So I'll let you all put that together, and we'll watch Greeley grow overnight. Inventory is a challenge right now. Inventory is low, especially in lower price points. It is a seller's market with about somewhere between 1 and 3 months supply, depending on where you are. And that balanced market was 6 months supply. Homes are selling quickly in Denver. They're getting multiple offers for the homes. Offers are being accepted above the list price. All of those things are indications of a seller's market. The other thing is that, I mean, actually inventory is down year over year. So just like 20%, 30%, depending on the market. Inventory is tight, very tight. The good news is those rates are amazing. So I know the prices are high, but because the mortgage rate is so low, we can still qualify for a monthly payment often with those things offsetting each other. Look at those numbers about how the prices have changed over the years. Yeah, did you have a comment, Alex?
I did. So you just talked a lot about what a seller's market would look like. Will you touch a little bit more on what a buyer's market looks like?
Homes aren't selling. Supply and demand, lots of supply. Nobody wants to buy. And so, and then the other thing that might be, it's a supply and demand question. Who's in charge? Is there more demand? That's a seller's market. Is there not many people want to buy and there's lots of people that want to sell? Now that's a buyer's market. Did something happen in the neighborhood? I know somebody that was in a neighborhood like where a home just blew up in the neighborhood. So I'm guessing that the prices in that particular neighborhood went down for a little while. So some things like that, you can find little pockets sometimes. Yeah, hope that helps. Okay, and the good news on the Front Range, people still want to come here. All you out-of-staters, you can say whether you want to be in Colorado or not. But you'll see where we rank on some national lists of best market for stability, okay? And the expected growth in your investment. So good stuff. Competing factors. Lots of people interested in buying and not enough inventory and high prices, low mortgage rates. The other thing that's an unknown for the moment because of the pandemic is everybody says, and I'd love if you would chat this if this is your position. I want to get out of an intense metro area and move to the suburbs or a rural community. So if that is true, if that is what is happening in this pandemic situation, theoretically prices in the suburbs and rural area will go up and prices in metro will go down because that's the supply demand picture. So I'm curious if anybody has a personal story about that's what they're thinking of doing. In the meantime, we'll talk about the process. Oh boy.
And real quick, Nancy, because I think it ties to your last question. Is it a seller's market nationwide currently?
So all these things are very much geographic. So again, a small town where the primary source of income just closed. Every year I think Florida gets hit with a natural disaster like a hurricane, and I think surely no one will move to Florida anymore. And yet they do. So, but yes, absolutely, very much a geographic driver what's going on in your specific location. And
And
that
then,
can, I think Kevin mentioned it earlier, it can even vary by neighborhood.
yeah, that's a good point. As another question, it says, I've noticed sellers dropping prices in a week if not sold right away. What is the strategy behind this when offers are above asking price in most circumstances?
They priced it too high to start. They have a contract for a job that opens in 2 weeks across the country. Yeah, a couple different scenarios that might be at work. Where, yeah, counter to that, I have a home in our neighborhood 2 doors down that I swear they were $50,000 under market. That thing sold quick, and I think they left so much money on the table.
Yeah, and it's interesting reading some of your responses about where you would move or how loans work. Just want to echo that there's lots of frustration around home buying. It's a frustrating process. So thanks everyone for sticking in with us. Along those lines, loan question. This person is currently furloughed. How long will they need to wait to get approved for a loan?
Kevin?
Yeah, I'll take that one. That is a great question because so many people are experiencing that currently. But as soon as you're back to work and you're active and you have your first paycheck, you can get approved for a loan.
It's that proof of payment.
Yeah, it's the proof
Proof
of
that income's coming in.
Exactly. You got it.
Awesome. And then one last question. What about earnest money?
So earnest money is related to you're showing a seller that you're serious, you're earnest about making the purchase. You pay this money and it's held by the realtor. Oh boy, Kevin, it's been a while since I've done a purchase myself, so correct me if I get this wrong. But it's held by the realtor and returned if the deal doesn't go through. So for instance, when I mentioned that we bought a house with our daughter, we were in the process of searching for that home. We found one we liked. We put earnest money down. It was held. When we went to do the inspection, the seller wouldn't let the inspector on the roof. We didn't like that, so we backed out of the deal and got our earnest money back.
Do all purchases have earnest money?
Yes, yeah. It's a good faith deposit that you're placing, to enter into a contract. So yeah, I mean, every real estate deal that I've seen, has that good faith deposit or an earnest money deposit. But that earnest money is then, if the deal goes through and you purchase the home, that money is just applied towards your down payment. So if you're down, if your earnest money deposit $1,000 and you're making a $10,000 down payment, well, you only have to bring another $9,000 to closing.
Okay, so great points, Kevin. And if you think about it from the seller perspective, there's a lot on the line for them. And for you to bring nothing and just say, yeah, we'd like this house, is pretty spooky to a seller. There's a very good reason why they would ask for earnest money. Okay, here's kind of the process you would go through if you're in that, hey, let's do it. Let's buy a house. First thing is to get pre-approved with a lender. The word pre-qualified was used earlier, and there really aren't pre-qualifications anymore. That's more of a general look at things. Pre-approval is we've pulled your credit score, we've seen your page stubs, we've looked at the documents, we've talked about it, and yes, we would give you a loan. Pre-approved. It's understood that you've been honest with us. We've told you how much you qualify for. We'll do the loan. A realtor won't take you shopping unless you are pre-approved in this market. So you work with a lender and you get that pre-approval. You're going to provide pay stubs. You're going to show bank statements. You're going to, there's some documents that you come up with saying, yep, here's all my numbers. Pull your credit, okay? And then you start, once you've got that pre-approval, now your realtor can show you homes in the appropriate price point. And so you can actually go out and look at things. You're going to talk with them about, you know, we have dogs, we have to have a fenced yard, or whatever it is that is your must have. And then some things I would like. In this market, we don't have much room for discussion about I would really like this. It's going to be down to what must you have. You can do your own research on coloproperty.com. I'm suggesting that as opposed to something like Zillow. Zillow doesn't update accurately. Coloproperty is the one used by realtors, the website used by realtors, and it does update several times a day. And so instead of wasting your time thinking you found a fabulous place that in fact sold 2 weeks ago. So use the right website. You're going to look, your agent's going to look, I don't know, your mom and dad, your sister, everybody's going to be out driving neighborhoods going, hey, those people look like they're going to put their home on the market. You're going to do the home search. You visit the home, you go back, work with your realtor, write up an offer. You know very well that other people are writing up offers as well. And the homeowner, the seller, says, I like this one. I'll take this one. If it's you, that's fabulous. If it's not you, then you kind of start over again. You go looking at some more properties, write some more offers until you're the one who gets picked. Okay. Any questions on that concept? Oh, I did want to mention first-time home buyer. The definition of a first-time home buyer is that someone on the loan, either you or whoever you're buying with, someone on the loan has not been a homeowner in the last 3 years. So if you owned a home 10 years ago and haven't owned it for 3 years, you're a first-time home buyer.
Cool. And I do have a handful of questions for you.
Oh boy, here we go.
Yeah, so let's start with how long is pre-approval valid for?
Ooh, great question. Kevin?
Yeah, it depends on the lender. I've seen them anywhere from 60 days to 120 days. The ones that we issue are 120, but usually it's in that time frame.
Awesome. Thank you. And these are just going to kind of jump all over, but we have lots of great questions, so I want to make sure we get to them all. What is the normal amount or percent for earnest money?
I would say 1% usually of the purchase price of the home is a standard amount for your earnest money deposit. Some realtors will kind of request that you make a little bit more to entice the sellers a little bit more to kind of show that you got more skin in the game. So, you know, it's really a good conversation to have with your realtors to determining that amount. But yeah, 1% is normally right around that amount that you'll need.
Great. Thank you, Kevin. If you don't have a monthly check coming in, but have a good amount of savings in the bank, will that help with a loan? Do lenders consider savings?
Yeah, this one's a tough one because, I mean, all lenders are obligated to show that you can afford a mortgage. And in order to afford the mortgage, you have to have a source of income, whether it's through regular employment, retirement income. You have to have some kind of monthly income to show your lender that you can pay that mortgage. By just having a set amount set aside in savings, it's not going to be sufficient to get approved for it, because unless you have other, income sources coming in monthly.
So a nice savings account is a wonderful thing, but not enough alone.
Correct. Yeah.
Such good questions all around. We got a couple more. So how would this process change if you're buying a home from a family member, say like your parents' house or your aunt or uncle's house? Would you hire a property lawyer?
Oh, that's a really good question.
Yeah, I would absolutely have someone in an official capacity look over the contract. Almost especially with family. And yeah, I think you probably don't need the realtor then. I don't know how you feel about an inspection. We'll talk about that in a second. But boy, I think maybe a real estate attorney might be a good option there.
Yeah, I agree. I would have like a real estate attorney look it over, or even title companies are a great resource for that, because they have their own internal real estate lawyers and attorneys that can help you prepare a good, solid contract between family members.
And a title company is still going to have to be involved, aren't they, in that transfer?
Yes, because they're, well, technically yes, because they're the ones that are going to be getting the title, making sure that it actually can be transferred. But yeah, a real estate attorney can really do the same thing. So a real estate attorney or a title company.
Gosh, these are good questions.
I know there's so many good ones.
That was a
And
great
thank
one.
you all. Continue to pop questions in the chat. This one says, we live in Colorado, but are still banking out of our credit union in another state. Will switching our accounts to a local credit union now affect our ability to get pre-qualified?
I'm going to go with no.
No, I don't think so. I mean, you'll have to document your transfer, to your lender. You'll have to provide them with bank statements from, the Colorado credit union, and then show the transfer to your new credit union that's in state. So your lender may want to just get a couple of months of bank statements for, each account to show that transfer, but it shouldn't affect your qualification at all. It's just going to become kind of a documentation headache is all.
And I think you're saying that do you even have to move your money? I think you could still be qualified, no problem, leaving it out of state.
No, that wouldn't be a problem, no.
And then
In today's world of international banking, yeah.
Yeah.
this question was actually asked a handful of times, so I'm going to try to combine it. And if it doesn't get to the point, please continue to pop it in the chat. But is it still typical to write a letter to the seller along with an offer? Does it give you a competing edge? Recommendations on that?
Seems to still be part of the deal. So if you haven't done this for a while or you haven't heard about this, because sellers are receiving so many offers and they're receiving offers, really strong offers, realtors often encourage their buyer to write a letter to the seller explaining why it is the seller should sell to them. And so that heartfelt story, oh, this house is exactly like the one I grew up in, and we're going to have kids in 2 years, and we want them to go to the grade school down the street. And so those kind of stories seem to still be working as far as the seller. There's still going to be, depending on the seller, cold hard cash beats an offer that's waiting for someone else's home to sell before they can buy. But yes, that is a common practice.
Yeah, and I saw a post earlier about somebody that was looking to move into the mountains at the Netherland or Blackhawk, and that might be a good way to maybe set your offer apart, is by putting in a letter like that, about your home and how much you really want to live in the area, so that might be a good strategy too to help get your offer accepted.
Awesome. Couple more. And again, thank you all for the questions, and thank you, Nancy and Kevin, for answering them. When looking at a newly built property, is there a benefit to using their mortgage lender versus finding your own?
Incentives? Yeah, Kevin.
Their mortgage lenders usually are, in it for their benefit, and they're going to maybe hide, fees in there or charge you certain fees or a higher interest rate. They're not always the best to go with, I would say, in my personal opinion. I think a bank or a credit union that you have a relationship with, that their business practices, and that's who I would recommend going with, is somebody that you have a relationship with already established. Their mortgage lender may offer those closing cost incentives, or payments toward your closing costs, but they're making it up for it some other way.
And I was going to say, I think you set us up for this next question nicely. It's if you're looking to use a certain institution as your lender, does it help to use them as your primary bank so that they can see typical pattern of income and spending?
Not necessarily, because as a mortgage loan officer and through our underwriting, I mean, we're not going to necessarily look at your accounts as far as what your spending habits are, or if you're going up to the casinos all the time. So, I mean, we're really not going to take that into consideration. But having that relationship with that local bank or credit union, yeah, by all means, they're you'll have that built up relationship because they've seen if you've had an auto loan with them, they've seen your pay history. They'll see how much you have on deposit with them. So by all means, yeah, I think it's a better relationship when you deal with somebody that you already have that relationship with.
So, and I'll add one thing that often comes up is, do people hang on to the loans or do they sell them? So like that home, the home builder probably isn't going to hang on to that loan. They're going to sell it to somebody.
Yeah, great point.
At least at Canvas, we hang on to the loans. You make your payment to us. So depending on how you feel about that kind of thing, your money might end up leaving the area as opposed to staying here.
Yeah, that's a great point, Nancy.
And then how about, is it true that if you approach multiple lenders at the same time, your credit won't be impacted as badly as if you approach multiple lenders over a longer period of time?
Correct. If at all possible, have your credit score pulled within a 2-week period. But when you are comparison shopping for deals, everyone's required when you're shopping and comparing to do a good faith estimate. And that should have apples to apples comparisons. This is this fee, this is this interest rate, this is, I guess I don't know how else to say that, but does that make sense? It's a very direct comparison between two offers.
Awesome. And then one more, I'm just going to read it word for word. It says, because the market is so tight, we have a family member willing to purchase any house we want in cash to sweeten our offer, which has failed to allow us to nab any so far. We would just need to take a loan for the house amount later and use the loan to pay our family member back. We have talked with one lender who said this will not be a problem. Is this unique, or would other lenders be willing to do this as well?
Yeah. That is a good question. It becomes kind of it depends on who's on the title to the property, I guess. If your family member is the only one that's on the title, you kind of have to purchase it from them later. But if you go on the title with them, then you're just kind of refinancing it later. And then you can pay out your family member. But yeah, I could see lenders being willing to do that. It just depends on how you're listed on the deed as to how it would be processed.
So, and just to clarify, you can be an owner without being on the loan. So when we bought the house with our daughter, her husband, we didn't put him on the loan, but he's on the deed. So he's an owner, but he wasn't part of the mortgage payment. But boy, I'd do some dig deep and maybe talk to a lawyer or something about, do you think this will really work? A lot of trust in your family there.
Yeah, and I think that's a good one to end on. I think we got through them all, but if you have follow-up questions, please feel free to continue to use the chat, and I will let Nancy continue on.
We're close, people. We only have about 4 slides left. So the point was, you won the offer. Now you're the one that the seller's going to sell to. And so you need to get an inspection done. We strongly, strongly, strongly recommend an inspection. The inspection is for the buyer's benefit. It finds things about the house that may have been sketchy, you may not have noticed. So we strongly suggest that you pay for an inspection. It will come right out of your pocket. If you decide not to go forward with the deal, you've lost that money, but you know what you know. So strongly suggest getting an inspection. Then once that inspection's done, your realtor will help you negotiate. So say they found 3 things that don't feel quite right, you can insist that one of them get fixed or the deal's off, or you can let all of them slide, or you know, you can do any sort of negotiation with that situation once you have that inspection. You'll get the homeowners association documents. Please read them. You will be held to those. If you can't live with what that homeowners association document says, please don't buy the house. They're pretty serious about what they have in those documents. The title work we mentioned, it's going to get ordered up to be sure the home is able to be transferred, title's able to be transferred. The lender's going to order an appraisal. The appraisal protects the lender. The appraisal says, yes, this home is worth as much money as you are lending out on it. And then, of course, there's the fun of packing up, signing all those documents, and I do mean signing all those documents. There's a lot of documents. And then you move in, and you're a homeowner.
So on the off chance you back out after the inspection, do you lose money on your down payment?
No, you would get your escrow money back, your earnest money, sorry, you would get your earnest money back, and you would have lost the cost of the inspection, but then the deal's off.
And then are you the one responsible for finding the inspector?
Yes, yeah, because or your realtor is. You and your realtor will kind of work to find an inspector. Yeah, so and then you pay for that before closing, so you're paying for the inspection out of pocket.
Yeah, so that's protecting you, so you pick and you pay. Now that appraisal, you don't pick who does the appraisal, because that's protecting the lender, so the lender's going to pick.
And then could you comment on the average cost for an inspection?
Oh, what are we running these days? 500 to 700?
Yeah, somewhere in that ballpark, I think, Nancy. I know appraisals run anywhere from $600 to $700 also. Yeah, I think inspections are about the same.
And it's going to depend on where you live and how hot the market is and what's going on with that. But you do have to consider it's worth every penny, because the last thing you do is want to do is spend $400,000 on something that has a big problem.
Yeah, absolutely.
All right, we're going to cruise through these last couple slides. You can't stop me now. Okay, so you got in the house, you're the owner. Now you get to do all the things you want to do, make that property be a reflection of yourself. You also get to maintain it, and you get to invest in it. There may be some income tax benefits. You have to talk to your CPA. We want to stress that it's so important to have saved for emergencies. There will be things that come up with your home that you are going to either have to pay for or want to pay for. One of the things that gets suggested is to set aside about 1% of the purchase price every year. So again, on a $300,000 house, you would be setting aside approximately $3,000 a year or $250 a month to be for ongoing maintenance issues. And if that sounds high, keep in mind that a roof is, more than $5,000. A furnace is more than $3,000. Refrigerators are $1,500, and I could keep going. And those are the low end of some of those things. Home ownership is not for the faint-hearted or the unprepared. And if you want stories about cutting trees down, I'd be happy to tell you about cutting trees down. But I will save that for afterwards. So as we wrap up, yeah.
I was going to say this actually ties into cutting trees. So they have thought about buying a fixer-upper and renovating over the long term themselves, but don't have a lot of home renovation experience currently, but would love to learn. Do you think it's a good idea, or do you think it's a better idea to buy a more expensive, newer home with fewer renovations required? That fixer-upper versus new home.
That's a very personal question, and please know yourself. And if there's 2 of you in a relationship, the home may not be worth the relationship. Just saying. So, Kevin, do you have anything you want to throw in on that?
When buying fixer-uppers, it's going to be hard to get conventional mortgage financing because it's not in necessarily move-in condition, especially, if it's significant repairs that need to be made. Most lenders are going to shy away from it because it's not really move-in ready, or if it's just not cosmetic updates that need to take place. So you may have to seek special financing, which are called like hard money loans or private financing. So yeah, you may have to seek a different source of funds for that.
So it's going to depend on how intense is that fixing up.
Yeah, exactly.
All right, I'm going to move to the last slide, which is just a review of some of the steps you want to go through, and then we will jump into whatever questions are left. So, okay, you're still curious, you want to check it out, you want to keep going, do some work. Here are some things you should be doing before you start talking to realtors. Check out your credit report and your credit score. Your reports are available at annualcreditreport.com. Remember, they're free every week until April. Your credit score is available from a lender. Often there are deals out there. Your credit card company or someone will give you your credit score. You can pay for it through My FICO, but you'll want to get an accurate FICO credit score if you don't know where you stand at all with your score. Look at your budget, know your numbers. Talk to some people, find some lenders that you're willing to work with, a lender that you're willing to work with. And then the same with the real estate agents. Do your research and find out, had a great experience, do some interviews, come up with that. Annual credit report is for your credit score and for your report. What's on the report, making sure that's right. My FICO has a whole bunch of credit score information, and we may have that one on a recording, the credit score class. Canvas has calculators, so you can plug in different things, play with how much down payment, how much interest rate, play with the numbers, see where you stand. Kevin's information is there, because Kevin is a wealth of knowledge and a good guy. Colo Properties, where you want to do your searches for homes. The HUD site is just some general information about the home ownership situation. And then the CHAFA site has some information about first-time homebuyer programs. So different places you can research. Woo, made it.
And I just want to reiterate for everyone who also feels that deep breath, we will send out these slides, and this will be linked on the Alumni Association Young Alumni Programs webpage. So that's alumni.colostate.edu, and then navigate to Young Alumni Programs. So if you are ferociously writing down some of this information, it will be available hopefully by Friday. We did make it. Before we dive into questions, and we will get all your questions answered, but I also recognize we're sneaking up on 7 p.m. and want to be respectful of all your time. So I just want to give one huge thank you to Nancy and Kevin, as well as another thank you to our Alumni Association members. With that, feel free to stick around if you have questions. We're just going to keep working through the chat. If you are ready to log off, eat dinner, that is great too. I will send the follow-up information with my email, Nancy's email, and Kevin's email, and we're happy to connect during the night.
And the next class is about investing, October 20.
Yes, thank you, Nancy. We do the Young Alumni series monthly. So our October series will be investing, October 20th, and it will be our last one for the year before we wind down and give everyone a little break in November and December. So again, if you're interested, anyone can attend those, alumni.colostate.edu. But thank you so much for being here. We're just gonna work our way through the chat. Stick around if you want the information. If not, or if you're tired, again, this is recorded. You can always go back and later. But with that, I'm just gonna start throwing questions at you, Nancy and Kevin. Are you ready?
Bring it on.
We're ready. Let's do it.
Okay. So this one says several questions here on 8-10-10 loans. Can you talk a little bit more about how 8-10-10 loans work? Are they always a conventional loan plus a home equity line of credit? Does Canvas issue both the conventional loan and the HELOC, H-E-L-O-C, or would a second lender need to be involved? How common is this? Are HELOC always variable interest rates? Can you pay the I hope I'm saying this right. HELOC faster to get rid of it sooner.
Oh boy. Okay, so I'm gonna start with a couple things. Second mortgages can either be a line of credit, that's the LOC part of HELOC, or they can be a flat chunk of money that is given, not a line of credit. So it's still a home equity loan, but it's not a home equity line of credit. Okay, so two different kinds of that second mortgage piece. Canvas does do both. Boy, Kevin, keep me on my toes here. They aren't as common as they were a while ago. Those percentages can change. There's nothing magic about 80, 10, 10. So those percentages could change. And yeah, so there's tremendous variety. I think your best bet would maybe be to meet like with Kevin and ask those questions either by email or that kind of thing to make sure we got all those answers together, because it's a pretty individual situation.
Yeah, and I'll actually throw this in there. You're right, Nancy. They were more popular, I think, quite some time ago than they are now. This type of setup actually really can turn out to be more expensive than it would be just to pay mortgage insurance, because you're having to pay a higher interest rate on a HELOC for that 10%. Plus, you have to pay a higher interest rate because you now have a second mortgage. So you're going to have a higher interest rate on that 80% too. It really, unless you're going to pay off that second mortgage probably within the first year, it's not going to really be that beneficial. You might as well just pay that mortgage insurance and put less than 20% down.
And you know, mortgage insurance isn't evil. It's just a part of the deal. And then, yeah, but sometimes people have really strong opinions about that.
But yeah, that's a really, it really depends on your individual situation, I think. So it'd probably be best to kind of take that offline and speak directly with a lender, which I'd be happy to help, Jeremy. So feel free to contact me if you'd like to talk about it more in detail.
And for those of you who are planners, just to give you an idea, we have about 10 questions in the chat. So if you're wondering when we'll get to your question, sometime in the next 10 or 15 minutes. Follow up, is there a rule of thumb for how much money to keep in savings when you first purchase a house versus how much to put into your down payment?
Personal comfort level?
Yeah, I think it's recommended to have at least 2 months of mortgage payments and savings, to kind of, in the event of, job loss or a furlough, like a lot of us have, many people have experienced. So, I mean, at least 2 months in savings is probably a good idea.
How much does it affect or hurt your credit to get pre-qualified? For example, if they don't find a home within the first 60 to 120 days, will it hurt their credit to get pre-qualified again?
And I want to stress it's pre-approved, pre-qualified. It means you may have talked to somebody and asked some general questions, but a pre-approval is a pretty deep dive. And your credit score drops about 5 points when you take an inquiry like that. So it's not awful. And like Kevin said, that's gonna, 120 days is 4 months. Yeah, and so, and there's some other, if you're just curious about your
score overcomes it.
Yeah, say that again, Kevin.
Usually your credit score, you'll rebound from that initial drop after 4 months. I mean, it'll overcome it by the time you need to have it pulled again.
Yeah, it's not that big a ding.
And if you want more information on credit scores, we do have a credit score webinar recorded. If I haven't said it enough, alumni.colostate.edu. Next question. If there are a number of renovations that need to be done, can you get the amount to renovate as part of the mortgage?
Not with conventional financing, no. There again, you're going to have to seek special financing, such, like hard money loans are what they're called, or seek a hard money lender or private financing. But yeah, not with a conventional mortgage or, you know, like the other ones that Nancy talked about, like FHA, VA. Yeah, they have to be really move-in ready in order to get that type of financing.
Now, if you have the patience to wait a couple years and make some payments, and hopefully the value of the home goes up, then maybe you'll qualify for a home equity loan to be able to do those things.
Mhm.
But yeah, big difference between, ooh, I'd like to do some stuff, and I can't live in it until I do some stuff.
So a little bit change of direction, but does Canvas provide construction loans?
No, not at this time. We don't. No.
Okay.
There's a very limited number of lenders in the area that do that. Kevin, I don't know if you know the names of them, but that would be an offline conversation. There's very few.
Yeah, I mean, they're out there. It's just the problem with that is that, you know, the lender has to release funds at certain intervals during the construction process, which takes quite a bit of administrative work. And, you know, Canvas being, you know, not really a large credit union or financial institution, you know, we just don't have that capability. But yeah, it takes a lot on the administrative side. So a lot of lenders will kind of shy away from those type of loans. But yeah, I mean, they're out there. There are lenders that will do them.
How about, are resources such as Credit Karma fairly reliable for checking your credit score?
Yeah, so Credit Karma is probably going to give you a score that's a little higher, a little inflated. But in general, if you don't have an idea, it's a relatively safe way. You know, just don't buy anything. But it's a safe way to get an idea of where you stand. It used to be that you could buy your FICO score from MyFICO for less than $10. So it might be worth it to get that. There are some places, banks, credit unions, credit card companies that give you a FICO score for free. So as long as it's got that logo and it says, yes, it's FICO, it should be okay, that it's very close.
And then actually our last question, if no one has any others, but it's, could you just do a little refresher on what escrow means again?
Sure. So escrow was the funds that are collected by the lender and set aside to pay your property tax and your homeowner's insurance. So so if you got a loan with Canvas, you would pay us back your principal and interest amount each month, but we would also collect 1/12 of your taxes and 1/12 of your insurance. And then when that payment was due to the county for your property tax, we would have collected enough money to make that payment for you. And the account that it sits in while it's growing and waiting for payout is an escrow account.
Awesome. I don't see any other questions in the chat. So if we missed one or you have another one, feel free to pop it in. But I know we are slightly after 7. So thank you all for sticking around, and go Rams.
Go Rams. Great questions, people. Wow. Thanks.
Yeah, amazing. Yeah, it was an awesome session tonight. Thank you so much.
Alexandra, we'll find a way to have a beverage.
I love it. Hopefully we'll find a way, hopefully we'll find a way to start doing in-person stuff at some point. I know that we're a ways out, but we miss seeing everyone's faces. So thanks for sticking with us in this virtual format as well.
And rumor has it we might be able to see each other at a football game.
Rumor has it. I don't know. I can't confirm or deny.